Welcome to this week's Property Insider video. Today, Dr. Andrew Wilson and I give you an update on the latest property market data, and we spend a bit of time talking about a recent article that suggested that house prices in Australia, in some locations, are going up more than people are actually earning. In other words, their houses are making more than they are. Is this a good thing? Is it a bad thing? Does it mean property prices are going to crash? That's what we're going to discuss today. So if you're interested in keeping up to date in what's happening in property, please subscribe to this YouTube channel and click the little bell icon so YouTube notifies you each week when we bring out our regular Property Insider video. Some houses are earning more than jobs. How we lost control of Australia's housing prices and how we get it back. Now, they were a couple of the provocative headlines doing the rounds in the media last week. Today, I'd like to get the perspective from Australia's leading housing economist, Dr. Andrew Wilson, on this idea. Are house prices really out of control and are they going to plunge? But before we discuss that, I'm also looking forward to his update on what's happening around Australia's property markets. Welcome, Andrew.
Thank you very much, Michael. Yes, another interesting week in housing markets, and the usual debates continue to float around the media.
Now, Andrew, I don't want to downplay the economic hardship many small businesses are experiencing, or a lot of Australians who are having challenges with their jobs or stuck at home. But what are we going through? House prices haven't plunged like many pessimists predicted. Consumer confidence rose last week by the biggest amount in 11 weeks, despite Victoria's lockdown. Retail spending is up a huge 12.12% for the year, and the stock market rebounded 35% since March. We're having interesting times, Andrew.
Yeah, not a good week for the doomsayers, Michael. It's looking like deja vu all over again in terms of predictions of depression, house price crashes, an economic winter. Certainly things are tough. Let's not gild the lily too much, but not as bad as projected and by many. And we're starting to see the recanting of a number of those quite hysterical headlines, particularly in relation to the prospect of sharp declines in house prices. I think we'll see more of that. And as I said, have been saying recently, Michael, we may even get an uptick in house prices this year, particularly in Sydney. Now, how would that be for a shock? I'm not saying it's going to happen, but I think that there's a possibility that Sydney prices might start to rise before the end of the year. And other prices are really quite stable. In fact, we've just dropped about 1% or so since the coronavirus onset. And that's way short of what the predictions were, 10, 20, 30 plus percent fall in house prices. We shouldn't be surprised. The same thing happened last year.
Well, let's have a closer look at what happened over the last week or so, Andrew.
Yes, Michael, look, another solid weekend for auction markets. Sydney was the surprise, a big pickup, over 70% clearance rates in Sydney. Auction numbers continue to be high, but as we've discussed, this is more about the swap to these online auctions, which are transferring traditional private treaty sales to this sort of hybrid auction private treaty marketing tool. Other markets were around about where they've been. Melbourne held the line, 55% clearance rate, Michael. Numbers were low, of course. So again, with the shutdown, we need to take those results with a grain of salt. But there's no doubt that the Sydney market is producing some revitalised energy. We've seen that for a number of months, and now it's looking like it's moving into the next level above 70%. If we continue above 70%, we will see increased house prices. And Melbourne has certainly performed better during the shutdown than it did during the shutdown in April and May. But that's, again, a factor, not just that people are a bit more, used to the shutdown environment, but we are seeing more of these online auctions than we did back in April and May. If we look at new listing numbers, Michael, the national new listing numbers had been falling over recent weeks and troughed or over the past week or two. And we're now starting to see that pick up. New listings are starting to pick up, which we would expect given the spring selling season upon us. But another indication that vendors are reasonably happy about taking their properties into the marketplace. If we look at new listings compared to the same period last year, it does tell a different story. We're actually falling away now, Michael, compared to new listings a year ago. And no surprise, because the market did start to pick up quite strongly last year from August onward. And though our numbers are reasonable, we are now starting to track behind where we were a year ago. If we look at the capital city breakdowns, Michael, for new listings, we can see Sydney up, and no surprise that Melbourne was down again. We shouldn't, as I said, be surprised at the falling away of Melbourne. And if we look at the relative position of our capital cities in terms of new listings, the major capitals, we can see Sydney now well ahead in terms of new listing numbers, particularly compared to Melbourne. New sales, again, holding up quite strongly in Sydney. Been a surge over the last fortnight, and those numbers have consolidated. Again, no surprise, new sale numbers coming through over the past week have fallen in Melbourne and risen quite sharply in Brisbane. And when we look at the relativity or the relative position between the capital cities for new sales, we can see similarly Sydney well ahead of the rest in terms of the number of new sales being reported over the past week, and now clearly ahead of Melbourne. With key points out of that, Melbourne falling due to the shutdown, no surprise there. Other markets performing quite solidly, and no doubt the Sydney market well and truly head and shoulders above the rest at the moment.
Well, as you said at the beginning, Andrew, that must have disappointed some of the doomsayers, and it's made them come out with headlines like there are suburbs around Australia where houses are making more money than their owners. And recently there was an article originally published in The Conversation by two academics, but it received quite a bit of airtime, including in the ABC. And their conclusion was that younger workers have been completely priced out of the major cities. And their reasoning for this was real home prices have climbed 150% since the year 2000 over the last 20 years, 2 decades, while wages growth has climbed by less than a third. They said Sydney and Melbourne now rank as the most expensive cities in the world, and they then went on to quote home ownership levels have fallen. They've fallen from 70% to 65% in the last 20 years. Home equities dropped from 80 to 75%. But their concern is that housing in Australia is overwhelmingly privately owned. Yes, that's right, Andrew. So it should be, shouldn't it? Australians own their homes, don't they?
Another week, another incomes versus house price model from a group of academics. Let's just sort of get to the key issue here, Michael. I'll try to speak slowly this time, but I think we've got to understand the reason that house prices have increased since the GFC period particularly has been that we have seen a sharp decline in interest rates. Our interest rates, our mortgage rates fell from around about 10% in 2008, and of course now we have mortgage rates under 4%. This is an unprecedented fall in interest rates, in mortgage rates, and what that means, of course, is that homeowners or home purchasers can buy a property with a given income and pay more because guess what? They're paying significantly lower mortgage rates. So that means that the position between income and the mortgage repayments you're required to make remains basically the same, but you can purchase more because your interest rate is significantly lower. This is not rocket science, Michael. All you have to do is track the path of interest rates versus house prices, and you can see that inverse relationship quite clearly. The reason we have a position that's preeminent in terms of other similar advanced economies, the housing markets of advanced economies, is because we have such a rigid lending system. We have 4 major banks that do just about all our lending for housing. They are very much risk averse because this is an oligopoly, means they don't have to take risks because of the significance of their market power. So we have very rigid lending rules, 80-20 LVRs. You can't repay more than 30% of your income in your repayments. And banks maintain those very strict rules through the cycle. So that means the only variance in our borrowing capacity can come from either increase in incomes or a change or decrease in incomes or a change in interest rates. This is very simple stuff, Michael. And those that have that itch to scratch about house price crashes and housing market bubbles, are becoming increasingly frustrated because they're not seeing the outcome of these two-dimensional measures that compare income changes with house prices. You're missing the point, guys. It's about interest rates. And when we look back, and it's not about where interest rates are, it's about how interest rates change, Michael. In one of the pieces that you discussed, they mentioned that interest rates were low back in the 1960s, and yet house prices increased. Well, the difference between the 1960s and now, and we shouldn't be comparing completely different macroeconomic environments and lending environments, is that from 1960 to 1966, we saw incomes explode in Australia, up by 15% during that 5-year period. Of course, inflation increased as well, but lending rates remained the same. Lending rates were around about 5% for mortgages then, because lending was managed by the Commonwealth and state banks, government banks. So the point is that house prices increased because people had more incomes with a fixed interest rate to be able to pay more for their properties. See, it's not really difficult stuff, Michael. So look, also you mentioned about the rate of home ownership. Now, the latest census tells us that it really hasn't moved much at all, not that 70% to 65%. I think what we're seeing is some marginal decline in home ownership, depending on when we actually measure our model because of the cycle. We can have more first home buyers at certain parts of the cycle than others. So it depends when we measure it. But also we have a much more refined measurement process in terms of tenure type. If we look at the latest census, there's actually 3% of the home ownership model that actually have no tenure listed. So again, we have a more refined measurement process. And if we look at the number of those renting, which is at around 30% of households, it hasn't changed that much. So we need to be quite circumspect about the comparing periods with periods, not just through changes in the actual market environment, but also in our measurement process.
But Andrew, one of the other concerns is the level of mortgage debt. In their article, they say in Australia, mortgage lending grew from just under 20% of GDP in 1990 to over 80% today, while they said business lending hasn't gone up as much. But this is one of the arguments, the constant argument of the huge level of mortgage debt that's going to collapse. What do you say to that, Andrew?
Well, why hasn't it collapsed now, Michael? I mean, we have had this debate, these woolly measures now for a number of years, and yet defaults and arrears remain at very low levels, or at the lowest levels globally. And that is because of our very strict lending policies. In fact, that if we look at 2011, the percentage of those that were repaying 30% or more of their income in mortgage repayments was around 10%. Now, by 2016, that had fallen to 7%. So those that are repaying a higher proportion of their income in mortgages is actually falling. And we look at those measures, that's been quite remarkably stable. When we look at the proportion of income that's been delivered to mortgages, it's remained around about that 30% mark quite consistently, Michael. And again, there are no measures in the real sense in terms of arrears or mortgage defaults that would indicate any mortgage stress. This is a cheap headline, Michael, and likely to continue to be a cheap headline. But surely the acid test will be what happens to mortgage defaults and arrears and house prices during this recession we are now in as a result of the coronavirus. And so far, no sign of any of the doomsaying mantra coming true.
No doubt the government's allowing some businesses to remain on life support and some homeowners and investors being able to put off their mortgage payments. But a number of the banks have come out recently, Andrew, saying that the percentage of mortgage holders having these mortgage deferments is decreasing and some are already starting to pay them off. It doesn't seem to be as big a problem as some are making out.
Well, no, sadly for those that are looking for that type of a headline, Michael. And the other point that was made in that piece was this high level of investor activity. I think they mentioned 40% of activity in our housing markets are investors. Well, that's just plainly wrong. The last time we had that level of activity was 5 years ago, Michael, and that was only for a number of months. In fact, at the moment, the proportion of investor activity as measured by the ABC lending is down at record low levels of around 20%, and it has been falling sharply for the last 3 years. In fact, investor lending as a market share is now similar to that for first home buyers. So again, let's deal with the facts in terms of this seem to be ideologically driven predictions of house price crashes that just never come true. And as I said, at the end of the day, the key measure is mortgage stress in terms of arrears and mortgage defaults, and they remain at very low levels. And they have to be tested, Michael, during a recession. So let's see what happens, shall we?
Well, you're right. They are ideologically driven research, and that's not the way I think you should do research. You're an academic. I'm not. You shouldn't come with a conclusion and then try and find data to fit it, because that's easy to do. So what their recommendation was to provide a variety of alternative stable tenures for households, such as different kind of renting, public housing, selling dwellings to social housing providers at discount prices. In other words, they're pushing for social housing on the one hand, but on the other, they're saying that houses are too expensive. I would have thought they'd want more first home buyers in the market. And isn't that what's happening at the moment?
Yes, Mike, and that's a solid way for governments to support the housing market, and that is to tap into the still strong aspiration for home ownership that Australians have. And I guess they just ignore the rubbish that we read in terms of projected house price crash, because there's always significant pent-up demand from first home buyers. And let's remember, if a year ago first home buyers had moved into the market, and they started to a year ago, and ignoring all the negativity and predictions of price crashes, they're all got a big smile on their face, Michael, because they're around about 10% better off in Melbourne and Sydney in terms of their prices. But they also have the real bonus, the real dividend, and that is they are homeowners, which is something, as I said, Australians have a very strong aspiration for. We also had another piece, Michael, that's been released recently from the Reserve Bank, a discussion paper. Again, this had me scratching my head. It was about income to debt level, and they mentioned the house price issue as part of that. And in their stress test methodology, I was just astounded that they decided to use the prospect of a 40%, yes, Michael, 40%, that is a magic number, is it not, possible collapse in house prices in Australia. Now, they said that it was extreme to use that particular stress test, but nonetheless, to them, at least, it was plausible. And the basis of that plausibility was that we could compare it to overseas models of price declines, such as the US, which was down by about 45%, and Spain, which was down by about 55% through the GFC period. But you're not comparing apples and oranges, Michael. You might as well compare it to the housing market on Mars, because our finance models are completely different. And they mentioned that in their piece. They said that Australia has a very low proportion that those take out 90 to 10 LVRs, whereas countries such as Spain and the US in growth cycles have a very high proportion of those that borrow more than 90% of the valuation. The key difference, obviously, in putting a market under stress when you're allowing high numbers of your market to borrow with very low levels of equity. So they challenge plausibility of a 40% fall with the facts. And then they say they can also look at the declines during the last recession, where they've said quite strangely that house prices, real house prices, fell by 20%. Now, nominal house prices, that is prices not adjusted for inflation, are actually increased, Michael, by 10% from 91 to 94. But the big difference, of course, when you adjust that for inflation, was that inflation in 91 to 94 fell from 10% to 0%. So that's the obvious issue when you take the adjustment from nominal to real. But of course, we have no inflation in at all now, literally no inflation. So we don't have the capacity for our nominal prices to be impacted by a sharp decline in inflation, as happened during the past recession. It just bewilders me. I mean, it's one thing, some of these academic papers that come out, Michael, but for the Reserve Bank to continue on their, what it seems to be a hobby horse of negativity towards housing markets, despite having their predictions clearly challenged over the last 3 or 4 years, it becomes a little bewildering, particularly given how easy it is to challenge some of those assumptions that the Reserve Bank are making.
One of the things ingrained in our culture, Andrew, is home ownership. In a lot of European countries and other parts of the world, that's not expected. But here it's something we aspire to. It's not something that's just handed down or given to you. And interestingly, the sort of homes we live in are very different to what our parents lived in. The two-bedroom apartment, the size of those that a lot of people start off with today, is as big as the house that your and my parents bought when they first started off. But it's one of the great things about living in the best country in the world, in world-class cities. Yes, the sort of cars we drive are better than they were 20 years ago, the sort of houses we live in, the sort of appliances we have. It is a first world problem, but interestingly, as you say, the percentage of Australians who own their home or aspire to own their home hasn't really dropped over time, and we don't want it to change, do we? That's one of the great things about Australia.
Well, as you said, Michael, the level of home ownership has remained basically the same, and we've had some significant sociological changes over the last decade. We now have smaller fragmented households, single income households, and of course that means it's more difficult to save your deposit to buy a home. That means that there are longer periods for those in those more fragmented, smaller households with smaller incomes remain in the rental market or in other tenure types. And I think that it's given those changes to society, particularly in the composition of households and household incomes, that we've remained remarkably steady in terms of home ownership. And I think that confirms that we still have a reasonable and robust access to home ownership in this country. And I think we remain the envy of the world in terms of the balance that our housing markets provide. Nothing's perfect, and we can always work harder at it. But certainly we don't have the type of outcomes that have been predicted for decades now in terms of house prices or the level of home ownership. The old story, Michael, if it ain't broke, don't fix it.
Now, just to make things clear for some people who are going to be offended by what we say, we both agree that there has to be a level of social housing. There will always be some people that are going to need the assistance, and that's what we pay our taxes for, to help them. But that's for those who genuinely need it. But for others, I think they can't expect to own their first home as soon as they leave mum and dad's home. They've actually got to save, have a spending discipline, a saving discipline, money management, and then aspire to own a home. And their first home shouldn't end up being their dream home. You've got to work your way up the ladder.
Well, strong aspiration is all about challenges, Michael. If the challenge wasn't there, would the aspiration be as strong? But make no mistake, Michael, I have been a strong advocate that governments need to provide housing service for those that are marginalised. I think that's what makes us great as a country, that we do look after those that get left behind. No ifs or buts or maybes, and we always need to be able to provide adequate social housing for those that are left behind, those that are marginalised. And I've always been a very strong advocate for that, Michael. But we need to balance that the social housing need with maintaining a strong and robust housing market. I think we've got it right, and we certainly don't want to go back to the days of Soviet-style public housing taking the place of our private sector rental markets. But no, always a need for social housing, Melbourne, Michael, and that's something that I think we do very well now, and it's important to get the balance right.
Makes sense. Now, to finish off on a good note, if you look, there is good news out there. Sure, there's negative news as well, but consumer confidence rose this week, up 4.1 points according to the ANZ Roy Morgan's weekly consumer confidence measurement, and that's despite Victoria being locked down, and a lot of families are starting to feel better off. But the other interesting factor was retail spending rose. Annual growth in retail spending in July was the strongest for 19 years, Andrew. I guess it's because we can't travel overseas, can't even travel interstate. So people are spending, and they're spending a lot of money on their homes. They're buying furniture, they're buying white goods, they're doing DIY projects, I guess. And that's good for certain industries, Andrew.
Absolutely, Michael. And this is the point, that the flow of capital is still reasonably robust around the economy. The government has certainly supported those that have lost income through JobSeeker. Well, certainly there are challenges ahead. We will see higher unemployment. It is going to be tough for a lot of people for a while. Let's keep our fingers crossed that the shutdown policies end soon in Melbourne, and that we can, I guess, take the challenge of reinvigorating the economy without the concern of the health issues that have certainly, particularly in Melbourne, caused such havoc over the past month.
Well, we'll be back each week to give some commentary. And I know that the point I brought up today, this discussion point of this article, got you fired up. But I think it's useful to see the other side of things. And you're an academic, and it's interesting how you would have approached the research differently.
Yes, Michael, I think the point really is that despite a lot of negativity in terms of those house price crash headlines we've seen now for a decade or more, it's basically completely ignored by Joe Public out there. And our markets now are reinvigorating. Sydney markets now above 70% clearance rates. As I said, I think that there's a possibility we may even see some prices growth in most of our capital city markets by the end of this year. And that's just, again, a remarkable reflection of how robust and resilient our housing markets are, but in particular, those that buy and sell. And they've continued to do so over the past 6 months.
Look forward to catching up with you again next week, Andrew.
Thanks, Michael.